Welcome to another episode of Commercial Real Estate Uncovered. I've got Toby Mathis here with me. Thank you for taking some time on your Friday morning. I'm excited to have you here because I've had some people on this episode or on this podcast talking about, development, making money. But you are an attorney here in town, and you specialize in asset protection and tax. What do you want to call it? Be efficient. I wanted to talk about people. We make money, but the best way to keep it and be tax beneficial. So you specialize in asset protection and then being what's the word I'm trying to think of? Kind of tax strategies for businesses and real estate.
Yeah,
Is that correct?
I always look at it like three things, right? You're going to be looking at your asset protection, your tax planning, and your business planning, kind of all wrapped up. If you want to make it four things, you could add your estate planning, but you're always looking at things as a grouping, never just isolated.
That's a big point, and I wanted to kind of give an intro on you before we get into that, because so often I was telling somebody I work with, I'm always surprised when I sell somebody a building and they just put the building like in their personal name.
Don't do that.
And then you find out they have like 3 or 4 buildings, and it's just like literally they just own it personally. But I wanted to go over your resume and some of the companies you own real quick, because that helps, that when you're talking about this stuff, you really do know what you're talking about. Mm-hmm. So you've written a handful of books about this, 3, I believe. You have an awesome YouTube channel. I think you're pushing about 400,000 YouTube subscribers, which is pretty cool. Then you own Anderson Advisors, which is your law firm, but that's where you guys do the asset protection, and you have bookkeeping, and you guys do tax preparation as well with that company?
Yeah, so Anderson is actually global, so it's
Okay.
Anderson Global, and we have offices in Dubai and France and Switzerland and Cayman Islands and others. But in the United States, it's Anderson Business Advisors. And there is a law firm component. Like, I'm a lawyer, but I don't really practice.
Okay.
Right? What I would do is I work with individuals who are investors, and I make sure that they're navigating those waters well. And realistically, most investors, they don't want to sit there and have a lawyer on speed dial, right? They just want to know how to do things correctly and how to operate. And then if they need a lawyer, they can obviously reach out, but you're trying not to have them in your life.
I get it. They one of the cool things when I was you have a ton of content online, and but I mean, I realized you've been featured in like Forbes magazine and Money magazine and Fortune, and you were actually I don't think it was Anderson Advisors. You have Infinity Investing. I think you guys were named one of the 500 fastest growing private companies.
We've been on that list a bunch of times.
Have you?
Yeah. So as Anderson, some of our subsidiaries, but yeah, Infinity Investing is like my little baby. It's kind of fun. So we do over 10,000 tax returns for investors every year.
Wow.
So I get to look and see how they're actually doing, because like your neighbor may say, "Oh, I'm killing it,"
Yeah.
and then you actually look at their balance sheet, and they're killing it by getting into debt and buying leasing a new car, and they're mortgage their house, and and they're not doing so well when you actually look at it dollars and cents wise. And nobody can lie to me. I can actually look at your return and go, "How much did you make, Eric?" "Oh, I made $1 million last year." Try again.
Yeah, that's funny. Well, that's actually something that I noticed, because I'm a commercial broker and we rent and sell buildings, and a lot of times we'll get a tenant that shows up. It's the same thing. They're just, we're making all this money. They're driving a $150,000 car. Then you get their lease application, and they put it this way: the owner won't approve their lease application. Yeah. Well, tell me a little bit about the Infinity Investing. I know you guys do seminars all over the country, and you guys help people get into real estate investing and strategize the best way of getting into it and keeping it.
Yeah, let me just mess with you real quick.
Okay.
So Infinity Investing is based on this principle. If you can no longer trade your time for money, so I took you off out of the world of being able to earn commissions.
Okay.
How long would you survive off of the passive investments you have? How long before you have to start selling things off? And then once you start selling things off, how long would you survive? And so I use that as a number.
Interesting.
And so I figure out, all right, how much do I spend each day? How much is coming in? I use 5 income sources. So it's rents, royalties, dividends, interest, and short-term capital gains from options. Right? It's a real simple world, like really small. All right, what are those income sources? Because those are an asset is creating it. It's like rents are pretty obvious, right? If I own a single-family resident and I rent it to somebody, I'm not doing anything. The house or the property is doing everything.
Yeah.
If you have a commercial property, which you sold me one, yay.
Yeah.
And and I have it rented, it's generating. I know that was a labor of love. We won't get into that, but the idea is that you have the rents coming in, and those rents are what you pay your expenses with. And then I no longer have to work. If I have enough rent coming in to cover my expenses, I can go to Fiji if I want for 6 months. I don't need to worry about a job. But if I don't have those income sources and I rely on my W-2 or my 1099, my commission income, oh man, I might start feeling like I'm on the hamster wheel. I start feeling like I'm in the rat race. And so infinity investing is investing in infinite income sources where it's going to keep paying out for hundreds of years in some cases. You're looking at it going, all right, if I buy a single family resident right now, this is the part that I wish more people understood. Not only does it appreciate, we're all used to like, oh, I should buy a house and it's going to go up in value. Okay, that's great. You can't spend that. You can borrow against it, but you can't spend it. The income that it's producing is the big thing. And there's both of those. Rents raise, appreciation happens on the property. You're getting both. It's like it's like all of a sudden you're double trouble. You're doing two things at once. And the beautiful part in those situations is you're not doing anything. You're just sitting back, collecting the checks, and getting that appreciation. And that's what infinity is built around, is the principle of once you have enough coming in from your rents, royalties, dividends, interest, short-term capital gains, you're at infinite. You could live an infinite number of days without selling anything off, without changing your lifestyle at all. And it's usually pretty liberating. When people hit infinity, I'm always like, don't go backwards. That's it. You want a Lamborghini? Fantastic. Let one of your houses buy it for you. But don't sell off your assets that are producing this income and put yourself in a worse situation. You see people do it all the time. They're literally retired, and they unretire themselves because they think they're going to do a financial move or something. And it's like, you just want to stop them.
So like, I don't know, they maybe own a rental house that's producing fine and they sell it to go throw it into the stock market or something because they got some tip from their golf buddy or something. Like, is that kind of what you mean?
Yeah, they'll do that, or they'll get rid of a cash flow asset with the idea that they need to invest in something that appreciates.
Got it. Okay.
Yeah, because I have properties in some pretty interesting places, like Winston-Salem, North Carolina. Everybody's been there, right?
Sure.
No, they're just cash flow properties. They're $100,000 properties that make $1,000, $1,500 a month, right? It's not exciting. And I might say, boy, I really want to get into Florida, man. I hear that they're appreciating 20%. So I sell that cash flow property and I go to buy something that loses money every month for the appreciation. That's not too smart, right? That's going to bleed you. And the easy, like if somebody's listening out there and they're paying attention, assets feed you, liabilities bleed you. The way you know whether something's an asset or a liability is what it's doing to your bank account. So it's not real estate as an asset. No, real estate can be a horrible liability. Real estate can destroy you. It's fire, just as easily as anything else. So it's not stocks, this, that, and the other. If I'm buying stocks that pay me. If it's not paying me, it's not an asset. It's a gamble. I'm hoping and praying that it goes up in value. And you could have a 2008 where, maybe you have 10 years, or 2001 or 2002. We had crashes in 2003. We had all these crashes, right? Sometimes you're waiting 15 years for a company to come back. Just go look at the chart on Microsoft. They're high flying now, but there was 15 years where they didn't move.
Yeah.
You went backwards. Inflation made your stock less valuable. So if it's not producing income, you can't spend it. You may be in a situation where you're sitting on this, I got this great investment, and then you have to sell it. A lot of our grandparents, a lot of our parents went through that, right? And they're like, I'm selling off my assets because my financial plan was this 4% a year, and I'm going to sell stuff off. Once you sell it, you can't get it back, right?
Absolutely.
It's gone.
They, it's funny when you say that. I'm a big believer in that too. I mean, I don't think it's too complicated, and I think when people overanalyze things and they're buying these fix and flips, or they're buying in a hot area because they're going to build a stadium next door, or whatever. But just I call it, I like the stuff that isn't sexy. I mean, I'm always surprised with clients that I have, I sell them a building because they have a business that might not be that exciting, but they're crushing it with it. And then they want to go open something like a bistro or a cafe, and then they lose a ton of money on it because it's more fun. They think they're going to hang out with their friends and drink wine. But like, so that's interesting. So like, what about debt with that kind of stuff? Do you believe? Because like you listen to these big people on like the radio. You've got like your Grant Cardones of the world, and then you have like Dave Ramsey, which I'm a big Dave Ramsey fan. I'm not a big believer in having debt on your car or credit cards. I'm not a big fan of, but like Dave Ramsey's big thing is like, hey, if you can nail off the debt immediately, do it. And then you've got like Grant Cardone going, well, if you have a loan at 4%, never ever pay that off. Like, do you have a philosophy with that kind of stuff?
Yeah, it's real simple. I've never seen a foreclosure on somebody who had no debt. Right, so when all the pain was going in, like here in the valley, what did we lose? 75% of our values in 2008. It was
a rocket ship upside down off a cliff. It was crazy.
Yeah, we were just getting pounded, and I saw a lot of people have their lives destroyed. All those people were people that had debt, and I'm going to say there's a difference between debt and leverage. So I have very simple rules. Rule number one is don't trade your labor to pay for liabilities. You want your assets to pay for your liabilities. So don't you go out and get a car loan and go get a home loan and rely on your job to pay it, because in order for your life to be destroyed, all you have to do is lose your job.
Sure.
And then you're like, well, but I have equity. All right, there's a lot of people who were house rich in 2008 and still got destroyed.
Yeah.
Yeah, so I look at debt as being something that's on a non-asset. Debt on a liability is two liabilities. So debt on a car, for example, can be ruthless to you. It could literally destroy you. And everybody's like, well, then how do I get a car? Instead of buying the new car, you invest in assets. And it's as simple. It could be dividend stocks. It could be cash flow real estate. It could be REITs. It could be notes. It could be whatever. And then use the money that's coming off of that to pay for that liability. Not I'm working my ass off to pay for my mortgage and my car payment. And once you do that, I'm not a Dave Ramsey. He lets eat pork and beans and starve yourself. There's two pieces.
He can be pretty extreme.
He's super successful guy.
Oh yeah,
wonderful guy. I just say he's making a point, and he's right, and he's been destroyed because of doing the opposite. Dave Ramsey went bankrupt, I believe, at one point.
In his early 20s, yeah.
Yeah, and he learned a lesson.
Yeah.
Well, I watched clients get decimated in 2007, 8, 9, 10, and then here in the Valley, we were flipping. So I could tell you, like, oh, this is the greatest thing ever. Make 15%, and then every now and again you'd screw one up. All right, I put it into my portfolio. I just sold one of those houses that I did that with. We bought it for $60,000.
Wow.
Just sold it for $300,000. That thing was paying out $1,500 a month every month. And somebody's going to say, like, why would you sell it? Because I'm buying 3 properties that are all paying $1,000 a month in North Carolina, or I could do Kansas City, Missouri, or I could do Indianapolis. They're all about the same. Even Idaho Falls now, we're getting decent properties. During that whole time, there was 3 houses that we screwed up on flips that we ended up keeping, and they're all up 300% plus. They all have paid for themselves multiple times over. Like when I actually look at how much rents come in, it was more than we paid for the dang buildings. I wish I could go back in time and grab every single flip and just make it into a rental property.
That would sit on that cash flow.
Just sit on that cash flow. I screwed up because I said I'll take the short-term profit over the long-term stability. And I didn't understand that back then. I understand it now. And it's kind of like, hey, I could have an income stream that's going to go up with inflation because rents follow inflation. So it's like all these people that want to go out and buy gold. Go buy your gold. I used to joke. I said, go get some Coke instead, because at least you get high, right? Like,
at least you get a benefit,
yeah.
Or I don't say a benefit, a reaction.
Reaction. I'm sitting on my gold. I love gold. I'm just teasing, right? There's people out there, they'll start hating on you, but it's not an asset. You're not going to live off of your gold. You'd have to sell it. And I don't want to sell anything. I want the income. I want to live off the income. Let that income come in.
I totally agree with that. It's just there's some owners that I deal with. There's one guy, he's like in his late 90s here in town. He still runs around doing his own electrical work. I think he owns like 60 buildings. And he, between Utah Nevada and Arizona, and that was his rule. He said he never sold anything. He just didn't understand why, like selling it, and then he'd have this money, and he didn't know what to do with it. So he always said if he bought something, at least he knew he could get a rent check. And he's a really funny guy in his 90s. He said in World War II, the only job he had below the water in the Navy was the only person who had a job lower than his was the water. And he was telling me about how he used to like rub asbestos on this boat he worked on in the South Pacific with no gloves. And then he called me a sissy, and our generation doesn't know what tough is and all this stuff. But no, he just said, I mean, the reason I bring that up is he's just like, it's not a complicated equation. Just get rent checks from people and don't have debt on it, and you can rent it out for whatever you want. And he said what you said, which was you can't foreclose on something that you have debt on.
You have no debt on.
Yeah, correct.
Yep. One of the things that he's pointing out, though, is also he's 90 years old, right?
Yeah.
His rents, he probably started buying
60s, in the 60s. Yeah.
Right? So let's just think about
He's done
this
well
for a second. Yeah, so 60 years. I wonder what his rents were 60 years ago. Right? When you look at that, it's gone up. The U.S. dollar has dropped. I think it was since 1980 or something. It's gone down 70%. So like the dollar that you had back then is worth 30 cents. The 30-cent rent that you have is now worth $1, right? It's gone up that much. And you just never get rid of this stuff. I actually do an exercise with people where I say, like, what does your legacy look like in 200 years? Well, I'll be dead. No, but what you left behind? You built something. So like his buildings don't disappear when he dies. Those rents will still be coming in. And if he directs them to his family or he directs them to organization that he cares about, so like that we bought the building here, that is earmarked for nonprofit.
Yeah.
I go away, that's still going to be used for its purpose, and it's pretty much set. It's not going to go anywhere, right? It's going to keep being used. You can be very deliberate when you're dealing with assets about like, hey, this is for the education of all my descendants.
Yeah.
Like it's super simple to do these things, and they don't go away. They just keep getting better and better the longer you own them.
Do you mind talking about that? The building you bought for the charity that's part of it? If you don't, I mean,
yeah, a little bit.
A little bit. No, I was just curious. Yeah, you bought a building that's for a youth program that I thought was pretty cool. We could just leave it at that. Yeah, I did a deal with you where I thought it was really neat. The purpose of buying it was to help a local youth program. So, as you said, when you have some income coming in, you can actually do a lot of good with it, which I thought that was really admirable. When you told me you wanted to buy it, I was like, why? And then you told me the reason. I was like, okay. So I thought that was really cool that you did that.
It's for those of you who are into the world of MMA sports, I was a boxer. I was a kickboxer. And I always looked in. So I was in downtown Tacoma and then here with One Kick Nick, if you know who that is. Super.
I do now.
Yes. Super nice guy. Been doing this 30-some years. He was actually started back with Dana White, I think was training, and Floyd Mayweather's, his uncle, I believe.
Okay.
And they were all together. So like every now and again you hear Dana White talking about, he calls him Nick One Kick, but it's One Kick Nick, which that's a good story too. But runs a great gym, and you're just looking at it, it's like it's helping a lot of people. Helping a lot of kids. He has professionals too. He has UFC fighters and all that, and he's got some great world champions. He's probably the best Muay Thai guy in town. And you want to make sure that those types of programs don't go away, because society pays a pretty heavy price when you do. But you do that kind of thing, you could, anybody could do it. You could set it up. Here's what's fun. This is the tax side. If you buy appreciating real estate, and let's say that I buy a house here. We'll just keep it simple. I buy a house, $200,000 rental, and it goes up in value over the next 20 years, and it's worth $400,000. I've written it off at that point, pretty much. We have 27 and a half years. If you know what cost segregation is, you can accelerate it. But if I donate it to my own flipping charity, I get a fair market value deduction, so I would get to write it off again. So I've bought it at 200, it goes up to 400. I just wrote it straight line depreciation. And one day I say I could really use a $400,000 tax deduction. Great, set up a public charity for that purpose, whatever it is. It could be low income housing, it could be veterans housing, it could be low to moderate income housing, it could be whatever. Like those are all charitable purposes. And I could set it up, boom, throw it in there, take a full deduction. So I could actually write off a house twice. And I've done this. repeatedly on multiple properties. And you're always kind of laughing about it. Well, what's the benefit? I got a deduction of $400,000. Depends on your tax bracket. I've had properties that I've donated where the tax benefit on the donation was more than I paid for the property.
Wow.
So you're like, okay, great. Now it's in an infinite income stream. It's in something that's never going to die if you set up your charity right.
Sure. Yeah.
I use the Hershey Foundation. It was set up, I think, in 1905. At the Hershey School, thousands of kids get educated every year through there. That thing's worth over $13 billion.
Jeez.
Hershey's been dead for over 100 years. I think he died in 1935. He set it up 1905, right around 1930. So it's close to 100 years. He had no family. He had no kids. That thing can't get out of its own way. It just keeps growing in value.
That's wild.
That's the idea of some of these concepts is you're creating something that's not going to be torn apart. It's not going to go get probated. You're not going to have, hey, I gave it to my kids and then they screwed it up or they got divorced and it destroyed it. There's ways to set these things up to where it's perpetual. It's just going to create a really cool legacy and it's going to help people 50, 100 years from now, 200 years.
Well, and that's obviously an incredible cause. I mean, like the one that you are part of is a youth program, which is, we need as many of those in Las Vegas as we can get. So, they're teaching a skill. And so I thought it was cool that you were doing that you did that, but also there's a reason, it's doing well, but there's also a benefit tax wise. So that's actually a great place to pivot here. I mentioned before we got on this podcast that I'm always surprised with clients when I sell them a building or I'm going to sell their building for them. They just have the building in their name. It's crazy to me. And they'll be like, well, I just bought it and we put it in my personal name. And then they bought another one and that's rented out. And I'm always like, you need to hire somebody to help you go through this, not only for the liability purposes, but there's a tax benefit for it. And that I know that's what your Anderson advisors goes when you go on your website and you go through all the services you guys have. I mean, it's really wild, and I don't even pretend to be an expert in that. But like, what are a couple things that you could give, or maybe it's a common mistake that you see where somebody's buying an investment property, let's just call it a house, that they should do that protects them and maybe maximizes the tax benefit?
Yeah, we have the benefit of we have probably 60,000 clients nationwide, and you get to see things. And you get to see the worst case scenarios. Somebody buys their house. I'll give you a real life scenario. A guy was actually a rocket scientist.
Okay.
Down in California, and he bought a house in his dream house. Bought it. I won't give too many of the facts because I don't want someone to figure out the case. But bought it to where he was going to retire, right? And then he rented it out. He said, "I'm going to find a really great family to rent it out until I retire. I probably got another 10 years, and blah blah blah." So he was thinking ahead, and he thought he did a really smart decision. He put a family in there. Well, they flooded his house. Well, he had bought it in his name. He was easy to find in a public record. The family that destroyed his house, they flooded the downstairs, and then they let mold start to grow. So you're like, oh, this is great. You flooded my house, let mold come in it. Then they sued him for the mold. Jeez. And, of course, insurance doesn't cover a lot of the biohazards. Like, you're going to learn that there's lots of exclusions. So this guy ends up in a lawsuit for millions of dollars. They destroyed his house. They did a little, university of one of the universities, I won't say which one it is, but they went in and they tested it, and they said, oh, there's toxic mold in the air, right? This many particles for this. There's not even universal standards, right? You can go do a weekend course and become one of these testing guys. And got chased after. And one of the things they kept saying was, you obviously have money, you live, and they named his community in California because they could easily find him. So I always look and say, what's the worst case scenario? Well, that guy's life got turned upside down. He ended up winning at trial. The party that sued him went bankrupt, so he never got a nickel, and it cost him $500,000 out of his pocket, and his house is gone. And he got 4 years of getting drugged through litigation. And if you don't think that happens, just go drive around and look at all the billboards in Las Vegas.
Oh yeah, we'll call them ambulance chasers, or they're looking for. I mean, they make a living finding lawsuits.
The plaintiff's bar here is very strong, right? It's very easy to pursue somebody, and so I have simple rules. Number one is own nothing, control everything, right? Don't own things in an individual name. Don't let people know what you have. Make it to where you're not discoverable in a public record. And if somebody's going, you always have to have your name on a... No, you don't. You don't have to have your name on a building. You don't have, like, I could get your name off of your real estate. I could get your name off of your house. And you just think about it. It's like, why do I want my personal address out there in the public record? I have, doctors, a good friend who's a psychiatrist. The last thing he wants is his patient showing up on his doorstep. So we get his name off his property. Easy ways to do it. You can actually use a land trust with an LLC. And it's a personal property trust. It's not your traditional land trust for a couple of reasons, but I won't dive into the minutia. But it's a very, very simple vehicle. Gets it out of your name. And then all of your rental real estate, make sure that it's pointed into a limited liability entity of some sort. In some states, you can use series LLCs. Some states, it's LLCs. Some states, it's statutory trust. Some states, it's land trusts. And there's always somebody immediately who doesn't know what they're doing, and they immediately, you can't do that. You can't do that here. You could do it in every state. How do I know? Because we do it day in and day out, and we've been doing this since the 90s. And it works like a charm. You end up not getting sued when people don't know what you have. And I can take your brokerage accounts. We could do the same thing. We can make it to where somebody cannot find you in a public record. But what about the Corporate Transparency Act? It's not a public record. Stop it. Let somebody who deals at this area look at it and say, what's the worst thing that could happen in your situation? So a doctor goes out and buys a property in Henderson. I'm going to be a landlord. Great idea. But if that property and a lawsuit on that property could garnish you for the rest of your career, you might want to rethink that. Put it in an LLC, please.
And it's not that expensive to do.
No.
I mean, especially on the scheme of things like the example you just used.
Cheaper than the alternative.
And also, there's tax benefits to it too. A little bit.
You get so in some cases, yes. If you use a management company and you can always get tax benefit off of real estate. The Internal Revenue Code is really designed for investors. Like if I buy a piece of property and I live in it. So let's say that you and I are neighbors.
Okay.
I rent my house out to third parties. You own yours. Same price, same house, $350,000. We each buy a house. I can write off my repairs. You can't. I can write off my property taxes. You're limited. You have to do Schedule A, and you have your state and local tax limitation. I get to write off my interest. You're limited. You could write off some of your mortgage interest. In that case, it's below the threshold, but there's caps on that too. It's Schedule A. You have a standard deduction, and more than 80% of the people use a standard deduction. So you have about a 20% chance of getting to write some stuff off, right? I can depreciate mine and actually create a tax deduction. I could create a loss. I could actually offset my W-2 income with that dang thing if I'm a real estate professional or an active participant in real estate and I qualify, or if I'm using it as an Airbnb, I could qualify. You don't, because you're just a regular person owning something. So the actual big difference is, am I an investor? Am I trying to get profit out of this thing? And if the answer is yes, and I put it in a service and I become an investor, then there's a bunch of tax benefits. You get that whether you're an LLC or an individual. In fact, we don't want to get in the way of those benefits. But what ends up happening when I start using an entity structure is, number one, entities don't die. So I buy a same situation. I own mine through an LLC. You own yours in your individual name, and you die. You are going through a probate process, unless you have a living trust, in which case it wouldn't be in your name anymore. We'd have it in the trust, which is what you really should do. But let's just say that you own it in your name. Something happens. Erik passes away, and the next thing you know, your family is now dealing with the aftermath and having to go through the probate process, which all the probate lawyers are going to say, "Oh, it's no big deal," until you start going through it, and it's scary. And normal people don't tend to go to court and don't understand what all these pleadings are and don't like spending thousands of dollars on lawyers, and it is a big deal.
I've been in escrows, like we've had buildings open in escrow, and stuff like that's happened where like the proper people, like because somebody had passed away and it wasn't structured properly, and then you're in escrow, and then the person buying files a lawsuit because they obviously want their bill. It's just, yeah, it can get
I have
messy.
to force it through, and you got to get a judge's approval. And if it's super simple to go to court. That's what all the lawyers say. Oh, it's easy until you have to do it. It's kind of like losing weight's easy. Yeah, I just have to eat less and move more. What's wrong with you? Why can't you do it? Because it's not easy.
Yeah, I know. When I've been a broker in town for like almost 20 years, and you kind of become a strategic partner with a lot of your clients, and you realize like the same attorneys pop up in town that you deal with. So like I'll have 3 or 4 clients, and they don't know each other, but they have the same attorney because, as you mentioned, like they structure the stuff the right way. They don't want anybody to know like what they own or
that's it. Rule number 1
is don't know. Well, even
control everything. Don't own a damn thing because you die. Entities don't.
You want to make it easier for your family in the event something happens to just pass it on.
So my dad came from humble beginnings. He was in Alabama. My grandma left school at 5th grade to work in cotton fields. So my family was not wealthy. She wanted to leave some real estate to my dad. So she bought 2 lots, and it sounds weird, but it's a mobile home park, right? You're like, so in Alabama, that was going to be the inheritance she left to her son.
Okay.
Never made it through probate. The probate was more expensive than just letting those lots go back to the state. So she passes away, and people don't think about this. You end up going through, like, you can avoid the probate process completely. Just if you do the own nothing and control everything, you use a living trust. You can avoid probate pretty simply. There's no excuse nowadays to put your family through it. But in that particular case, the cost, because we were living in Washington State at the time, and I remember my dad's talking to these law firms, and he's like, I don't believe it. The lawyer fees, the retainer was greater than the value of those lots. These were not, like, these aren't $1 million lots, right? These are $10,000 lots. And it was more expensive to actually probate. So my grandma's lots, where did they go? Back to Alabama.
Jeez, that's crazy. That's wrong.
It happens.
And I mean, like, I just find that wrong. Somebody works their whole life to build up something, and it just disappears like that. I mean, obviously that's why you need to make sure you have your trust structured and all your buildings.
It's so simple to do it the right way.
It is, but well, we already said this. Like, I see it all the time where people just buy things in their name, or they have the same entity that owns a bunch of buildings, or they have an entity that owns their business and they buy buildings in it because it already exists or something. It's just
and you're actually raising a good point. Is when you're putting something in a box, the easiest way to think about this is, let's say that I'm traveling and I have a piece of luggage, and I put my shaving cream in with my nice shoes and my suit, right? And that shaving cream gets up at altitude and starts to leak. It's all over my stuff. Well, it's in the box, but they're all exposed to each other. So you do need to isolate your buildings. So you're not sticking 5 buildings in one LLC, because something happens in building 1, they can take building 2, 3, 4, 5, right? So you want to isolate them. And it's easy to do. You use series LLCs, you use a different LLCs. End of the day, it's basically insurance. It's, if something happens on this one property, I want to make it to where they don't take my other stuff. And somebody might say, well, I don't have any equity in those other properties. They can still take the property. They can take the revenue stream. Remember, we're buying these things for the income that they produce, not just the value of the property. We don't want someone to sit there and garnish your rents for the next 20 years either. We want to make it to where they're limited. They get this one thing. They can get the equity in that one building. And if you've got time, I'll share one story.
No, please.
This is one of those things that changes you, right? I was speaking to a bunch of real estate investors, and I think it was 1999. And I wasn't a big real estate investor at the time. I was just schmuck lawyer. And I'm talking to these guys, and there was a gal there, and she was obviously older. Like, I don't know what her age was, but probably 80s and beyond. And we were in a real estate club, and they were talking about investing. And they brought me in because I became a lawyer, not because I wanted to be a lawyer, but because I was in business, and my mentor was like, you need to become a lawyer because our lawyers are idiots. They're horrible business people. Lawyers will admit this too.
Yeah.
Right. So I went to law school. I don't really practice law, right? I'm a business guy, and I'm an investor. So I'm talking to this group, and here's this lady, and I said, ma'am, what brings you in? Because it was odd, right? These were young people looking to become real estate investors, and here's somebody, and she said, I don't want what happened to me to happen again. I'm going to do it right this time. Of course, you hear that. Do tell. Like, what's the story, ma'am? 15 properties she had.
Oh my God.
And commercial and residential in multiple states. And so she had a commercial building, 3-story. Still remember it. Like, this is the thing. It's like certain things stick with you. And she was like, we had property managers. I had a great lawyer. We had insurance. We had an umbrella. We have all these things. And the one thing we didn't have is we owned them all ourselves. And we had window washers washing the 3rd story of a commercial building. The property manager made sure everybody's licensed and bonded, all this good stuff. And they were using aluminum ladders with aluminum squeegees.
Okay.
And they touched a live wire. So guy on top, electrocuted, dead. But it's not like the movies where they fly off, right? So he's on the ladder, and his buddy goes to save him, But the damn pole was connected. The guy never leaves the ground. So we had 2 electrocutions. And she said it was like dominoes. They go after him. The insurance says you failed to verify the license and bonding of these contractors, and they had let their license expire. So they refused coverage. So she's fighting with the insurance company, fighting with the families. Jeez. And she said they got a large judgment against the first building. They're foreclosed. It wasn't enough to cover the debt that was on the building. She had deficiency. They go to the next building, foreclosed on it, same situation. And they're selling off her properties. They sold her home. Everybody's like, there's a huge homestead in Nevada. Well, she didn't live in Nevada. She had like a $35,000 homestead, which means when she went bankrupt, she could protect equity of $35,000 in her house. That was it. They took every single property.
Just because she didn't have it structured properly.
Just because she didn't have it structured properly. That was it. If she had just had a single flippin' LLC around that one building, it would have stopped there. And we've seen that play itself out multiple times. We had brothers both get sued. One was our client, one was big California firm client. Everything was transparent in the brother that wasn't ours name. So they get sued for the same exact thing, and they dismissed our client saying you didn't have any money.
Because it was structured properly.
Because they couldn't see anything he owned.
That's
right?
crazy.
And it literally, because that's how some of these guys are. The calculus is, how much is my claim worth? What is my chance of getting that claim through? And then what is my chance of collecting on it? And people forget that last part. You don't see too many homeless guys getting sued because there's no collection. What am I going to get? Your cart, your shopping cart? Like, no. Like, there's no reason to sue you because even if I win, I can't collect anything. So when somebody's looking at you as a potential defendant, you want them to come back and go, oh, Erik really doesn't have anything. He doesn't even own his own house. This guy's, there's no reason to try to shake this guy down.
Is that part of the reason you see a lot of Delaware and Wyoming entities? Like,
Wyoming.
Why? Like, I mean, I see why my. Why do you say that? Like, just
so Nevada, I used to act as a nominee. I still do on a lot of properties.
Okay.
Or on a lot of entities where you can have somebody step in just for a split second and do all the state filings. And I always put nominee next to my name. So if anybody ever looks at Mathis, you'd see thousands of these, right? All that means is that the owners are not disclosed to the public. Manager, the members, the officers, directors. Nope. You're not entitled to it. Why would I tell you? The only reason I would tell you is if I had to for maybe for lending purposes, somebody wanted to see my name on it, a bank. Otherwise, I'm going to be like, no, it's none of your business. Wyoming, you don't even have to do that. Wyoming, we have nothing. It's literally just the registered agent, which is us, and the organizer, which is us. Clients nowhere on there. And I deal with this on a daily basis of subpoenas and people trying to figure out who owns this. I'm like, it's irrelevant to your suit. Go pound sand. Right?
and this is where, this is why I wanted to have you on here, because it's hard to make money. Like, This day and age, like, I mean, it's a competitive place. There's everyone's trying to steal your idea or do what you're doing better. So, like, if you do have some success in this world, keeping your money is a whole nother battle. So, like, just structuring it properly, and this is just a repeated thing here, is that people just don't do it. So when the stories that you told, where this woman lost 15 assets because she didn't have an entity that's, I mean, what is an LLC? Like less than $2,000 to set up? I mean, it's pretty minimal. That's the state fee.
Eric, this is funny. We actually have an unlimited LLC program. Not very expensive. You could set up 100. It's going to be less than $100 a pop.
Is it like a subscription, or like what is it?
It's a set one-time fee, and then we just set them up. Yeah, as long as we're the registered agent, we don't care. And all you're trying to do is like, I don't want the excuse. It's $1,500 to set up I don't want to hear that.
Well, have you hired an attorney like for a lawsuit? Like $1,500 goes by a lot faster
in about an hour.
Yeah. It's crazy.
Yeah, if it's DLA Piper, like some of those guys, it might be by the microsecond. I love those guys.
And that's the no. I mean, and that's the whole thing is like when it's hard to make money. It's harder. It's often harder to keep it. So like you see a lot of the, I don't know, crypto. A lot of guys made money in crypto and they don't know what to do with their money. And like I've met a couple guys who I couldn't believe it. I had one. There was a guy in there's a business group I'm part of. I'm not going to say what it is because I don't want to share who he is, but he had a company that he sold and he was telling me he retired. I'm like, you got that much off of your company? And he's like, no. He goes, I did well on it, but I invested in crypto early. He's like, I have like $3 million in the bank and I don't know what to do with it. Yeah. I was like, dude, you better talk to somebody about something because he's like, it's just in his checking account.
Don't leave it in the checking account. You only have $250,000 of federal insurance. Like, get it into here's one little word of advice. Banks, when you deposit monies there, it goes onto their balance sheet as an asset and a liability, right? It's actually an asset. They're going to loan against it. If I go to a brokerage house, it's like putting it into it's third-party trustee. It's like putting it into a safety deposit box. I want to have my money be my money. I don't want to have to worry that the bank fails and I lose my money. So there's federal insurance on the bank side. There's also the similar type of thing in securities, but it's kind of fake because your money's not their asset. Your money is actually in a separate account. The only time where you've seen a trustee where people lost money, the trustee mixed it up, was Madoff. Because if you go to Schwab, they're using a third party trustee to custodian the money.
So yeah, a much better place to
don't leave it in banks.
Yeah. So just kind of on this topic, but how do you stay up to date on all this stuff? I mean, it seems like every night on the news there's some guy coming out saying tax codes changed or this changed. I mean, how do you guys stay up to date on all this stuff?
There's 500 of us, and we do it. You just how do you stay up to date on what's going on in the valley and in commercial real estate? Right, you're doing it day in and day out. You're learning just because you're immersed in it.
Yeah.
So I always say to people, like, if you're going to use a professional in an area, make sure they're doing what you're doing. So you could go to law school and you could read a lot of books, but that's not what's going on in real estate, right? Whatever those cases are, it takes years and years and years for a case to actually get to an appellate court or Supreme Court, and things have changed since then, right?
So what's some stuff you do for fun? Do you have any hobbies outside of real estate investing, or you just this is your fun?
No, we travel a lot. My wife and I go all over the place. We're nomads, right? We try to get out of the country for a few months. It's fun to see other, but I don't really look at what I do as work. I create a lot of content and I talk to cool people all the time and successful investors, and I cherry pick my clients that are making money. I'm like, what are you doing? It's like we're having a conversation. You learn something off a conversation. I learn from you. You learn from me. We're always talking. If you were my client and I was doing your taxes, I'd be like, Eric, hey, what are you doing with the real estate? Oh, I'm doing industrial in Vegas because it's absolutely on fire and there's not enough of it, and Amazon's coming here and this is coming here and all this stuff. Like, you'll know things, and then just by interacting with it, I'll learn it. So
proximity is a big deal.
Proximity is a huge deal, and then just being curious. Like, again, I'm a lawyer, but I'm not a lawyer. I say I'm not yes, I'm trained as an attorney, I'm licensed as an attorney, but I'm not an attorney. That's not what I do. I don't go to court. There's people that do that day in and day out. I don't think you could have a hobby and be a really great trial attorney. I think it's kind of like Kobe Bryant. I don't think had a whole bunch of hobbies when he was the greatest basketball player. Right? What did he do? He played basketball.
Boy, got stories of that guy. Like they'd interview other players and they'd talk about like when they'd come for the national team training here in Las Vegas and the guys would want to go out and he just wouldn't do it. They'd be coming in at night and he's going to the gym to work. Yeah, he just So I wanted to ask you about some of the books you've written. You have 3 books that you've written. One was How to Get Rich, How the Rich Get Richer, and How You Can Do the Same. Do you what made you wanted to write a book?
That was actually Forbes. It was Infinity Investing.
Okay.
How the Rich Get Richer and How You Can Do the Same. There was a bunch of different title things, but they didn't like some of it. And I was like, Escaping Financial Slavery, and they're like, you can't say slavery. But I think that they trap us. I think that debt traps us, and I think that stinking thinking traps us. They tell us what assets are. So, like, you deal with this when somebody goes to get a loan and they look at their balance sheet and they have a whole bunch of liabilities listed as assets. And I'm like, that's not an asset. It's not paying you anything. You're going underwater. You got your house. That's not an asset. It's a big old fat liability. You're paying every month on it. Your car's not an asset.
No.
It's listed on your balance sheet as an asset. That's fake, right? So it's getting through some of the myths and making sure people actually understand what's the reality, which is far different than a lot of times what they are telling you, especially at the banks. I've written 4 versions of Tax-Wise Business Ownership, that thing, over 20 years. So I've actually published that numerous times.
And that book's based on like being smart about your taxes. Again, making money's hard. Keeping it can be harder sometimes.
There's thousands of pages of code, tax code, horribly complex, usually written as though Congress was drunk at the time, right?
Possibly.
Then they have to do regulations, and they got to say, here's what we interpret it as, and then you fight over the regs, whether the IRS has the authority to do certain things. We just had a huge Supreme Court case where the Chevron deference to the federal government went away, and then IRS has gotten tanked on a few of its unilateral rule changes without public comment, and a few other things. Like there's always stuff that's going on and nobody knows it. So what you're trying to do is learn the path that keeps you away from the IRS and away from trouble, and using the incentives that Congress clearly laid out. We call it black letter. You stay away from the gray, stay away from things that are obviously fraudulent. So like you're entitled to certain things. Just make sure that you're receiving those certain things. And it's really weird. Like if, again, you and I are business doing the same exact business, maybe we're selling pizzas, right? The way you set it up, you might be paying 10% more of your gross income in taxes than me, simply because I structured myself. Maybe in this case, it's an S corp versus a sole proprietorship. And then your audit rate is 300% to 1,000% higher than mine. You lose your audits 94, 95% of the time, while I might lose mine 60. Right? There's that big of a difference. So you pay way more, you get nuked way more, you get to deal with the IRS more. And it's literally a one-page statement that you're sending to the IRS as to how you're being treated. And that's the difference between those two businesses. But from a tax standpoint, it could be huge. Like the difference between being able to retire and not being able to retire.
Well, that's a huge thing. I think in 2023, the average household income in America was about $76,000. So if you're talking 7 or 10%, I mean, that's $7,600. That's a lot of money.
And it's in that particular case. So let's say it was a sole proprietor versus an S corp. Sole proprietors, you pay employment taxes, old age, disability, and survivors, and Medicare on 100% of your net profit. So let's just say you're making $80,000 a year. The math is about 14.1%. So, what is that? Do the math real quick. Let's just for giggles. So it would be about $11,280 in employment taxes, not federal income taxes.
It's crazy.
Employment taxes, which is one of our huge money generators. If I just made that into an S corp and paid myself a $20,000 salary, which, by the way, I could stick right into a 401k if I really felt like it. But let's just say I didn't. I needed the money. And all I did was run it through an S corp. I would take payroll of $20,000. I am going to save employment taxes on $60,000. I will not pay that employment tax. And it's 14.1% or thereabouts of $60,000, which my tax savings sounds weird, right? And I know there's somebody out there, it doesn't work that way. Yeah, it does. It's $8,460. So on $80,000 a year, your tax savings, just because you made the right tax selection, is $8,460 a year. Not one time. And there's other benefits by doing it that way. You have something called an accountable plan. You could do something called 280A, which is the Augusta exception. You could do an administrative office in your home, start writing off all your commute and all that fun stuff, right? There's a bunch of other benefits. But just knowing that you have that choice. Wait, I have a choice? And then on top of it, your audit rate on those facts, I think it's 1.4 versus 0.1%. So you're about, I don't even know what that is, over 1,000% more likely as the sole proprietor to get audited. And then they lose 94 to 95% of those audits. That's table 17B of publication 55, the last year they published it.
That's just crazy. It's funny. You mentioned lawyers are bad business people. There's a lot of brokers who they do really well. They sell a lot of buildings. They're great at their job, but they just are not good at their own personal structure. And working with someone like you, as you mentioned, the home office and structuring things properly, it's amazing what is a write-off and not doing a gray area. Or people who do their own bookkeeping. It just is beyond me. They're like, yeah, when taxes are coming due, I'm like, what are you doing? Oh, I'm doing my bookkeeping to give to my tax person. I'm like, what are you doing? Like,
you should have been doing that bookkeeping
quarterly.
Yeah, all along the way, and actually doing a little bit of planning.
So you also wrote a book. It's called 12 Steps to Running a Successful Business. Now, what made you want to write that? You have two.
A long time ago.
It was, but you have two. Successful businesses. So, like, out of those 12 steps, like, if there was one piece of advice you'd give somebody who's starting a business, what would you tell them they should?
I would say that right now. That is hilarious. Like, I remember writing that, and it was really off of a guy named David Gold. I'll tell you, like, my mentor was a guy named Jerry Getty, and he ran a liquidation company. Which back in the days, before you had overstock and you get on the internet, you actually had to sell stuff by calling people and faxing and all this. That's where I grew up in.
Okay.
Selling stuff all over the place. But he had a buddy named David Gold who started up the 99-cent only stores. And his real business was bargain wholesale, which sold to all the dollar stores. And then he made money on the other one too. But what was funny is Mr. Gold, who never changed his lifestyle from what I remember. Like, I used to see him at the ASD AMD show. Really great guy. Always wore a T-shirt and jeans. Never moved. Was a billionaire, never moved, loved his family, did what he liked to do. One of those guys, probably very much like your 90-year-old characters. Never going to stop doing what he's doing.
No.
Loves it, enjoys life, rich as heck,
Yeah.
That was him. And Jerry actually introduced him to that world of business. He was a discount liquor seller. So David Gold got into the 99-cent only stores from selling liquor. And Jerry was like, hey, we could do this. And David was like, I'm going to open up these stores, and I'll sell these. Jerry was always selling him liquidated merchandise, and then David would sell it out to all these other stores and stuff. And he said, I'll do the 99-cent onlys. But Jerry's problem with it is he didn't like the shrinkage. He didn't like the idea of people stealing from him. So he didn't do it. David Gold understood the numbers and was like, it's just a fact of life. Is if you're going to run a discount store, there's going to be a certain degree of people borrowing your stuff, stealing, shoplifting, shrinkage. Just factor it in. And that was one thing that I realized is know your numbers and factor in. I don't get mad if a tenant sues. Like, I have hundreds of properties, right? So some of the commercial stuff. But I have single families. We got 300 or something like that. I've had trees fall on them. I've had them burn down. I've had tenants trash places. I don't get mad. I don't get mad if a tree falls on a roof. I don't yell at the tree. It's just a cost of doing business. Figure it out and make it non-personal. Like, don't let that stuff ruin your day. Jerry let it ruin his day, so he thwarted himself. David Gold didn't let it ruin his day and became a billionaire. They were both super successful. Jerry, love him to death. He passed away years ago, but I always look at a lot of what he told me, and I still pretend like I'm talking to him sometimes. He'd be like, "What the heck are you doing?" He always, he had a funny way of communicating on some ideas, but I'd always be like, "Okay, Jay, so you just tap into Jerry wherever he is, and like, okay, what about this situation?" He goes, "It's obvious." Like he would always like try to dumb it down. So I still do that. But that was 12 steps. It was really know your numbers. And then one thing that I really remember about that was when I started looking at, they call it blue water marketing. Don't go where everybody else is going. If you are diving into like where the sharks are eating, there's a whole bunch of blood in the water, don't dive into it. There's blue water all over the place. Go figure out and start making your own market.
Blue water marketing. I've never heard that.
Well, you have. Right?
I'm even taking notes. That's a good one. Just be doing something. Do something different.
Do something a little bit different. Be disruptive. So, like, we have a subscription service where people, like, I don't bill by the hour. Somebody can subscribe and they can talk to lawyers and accountants all day long. What? Yep. And we have an open room. People can go in there and ask any question. If like on YouTube, we do Tax Tuesdays. I answer any tax question every other week. We bring on probably 10 accountants. Why the heck would you do that? They look at it like, Toby, you're giving away your time. Yep. And I'll keep doing it. Why? Because I receive 10 times back. It's just how it works. It's disruptive. It's annoying. I could go answer your question. You're not going to talk to your accountant anymore because your accountant charges you and usually gives you crappy advice. Right? So you could actually talk to somebody who lives and breathes this stuff, right? It's the difference. I own properties. I already know what the stuff is. I know what you're facing because I'm facing it, right? So I kind of know where you're coming from. So when I talk to a client, it's like I can empathize, right? I'm doing it too. And this is the reality. And this is what they're going to tell you. This is the reality. And you're kind of going through these things, right? So I just remember that. And all businesses have those areas where you could go out and just get outside of the red water. You don't need to go in there and get chewed up with everybody else.
That's a good tip is when you were talking about not taking it as personal. When I first got into brokerage and I'd spent a bunch of time with a client showing him space to rent or buy or whatever, and they went with somebody else. Turns out their cousin is an agent. I used to take it so personal. I thought they liked me. What's the deal? And then over time, you're just like, it's just part of business. But it also by not taking it personal, you actually learn what to look for. And those filters get a lot better as far as, it's like dating. I don't know. It's like more you date, you know what to look for. But
there's reaping and sowing.
Yeah, exactly.
And you never know which season it's going to be. Right? So you just kind of have to go out there and just decide what you're going to be. Are you going to be a giver and you're going to be generous and you're not going to worry about it? If you're that person, my experience is that you get rewarded over time. Yeah. Be a voracious giver of both your time and your money. Do things for other people, and it's weird. Somehow it boomerangs back and you end up being successful. I see it play out thousands of times now to where I'm convinced that there's like something out there in the cosmos. I don't know if you call it karma or what, but
what you put out there comes back. When I have in a bad mood and I'm giving out like a bad vibe, your whole day can go bad. But like I totally agree with that. When you're what you put out there comes back. I think karma can be a bitch, and I think you need to be really careful with what kind of energy you put out there.
And we carry along our luggage too that we get from our parents and everybody else. And money doesn't grow on trees, or it takes money to make money. Or, all that weird stuff that gets ingrained in your head, and you have all these beliefs, and you try to get through them, get rid of them. Instead, just change your mindset. Most of that stuff's BS anyway. It's like money doesn't grow on trees. Tell that to somebody with orchards, right? It's like, yeah, it does every day. Keeps coming if I treat it right.
What about someone getting into a business? What's a book you tell them to read or a podcast to listen to? I always like to ask people who've had a successful business, like what's one book that maybe changed your life or trajectory?
There's a few books, and I actually worked with a guy named Robert Kiyosaki for a number of years.
Yeah.
Rich Dad, Poor Dad. That'll change your perspective. It won't tell you what to do. It's maddening, and that'll make you realize, oh man, I want to do other things, but it won't tell you what to do. But that will be that for most people, that changes their trajectory. It makes them look at things critically and differently. So I would just tell people, Rich Dad, Poor Dad, Richest Man in Babylon's another one, Think and Grow Rich, another one. Like some of those things that are mindset, because your behaviors come from your beliefs. And if you could alter your beliefs, your behaviors will follow. And it all starts with that mindset. And it sounds weird, right? But if I could just, again, don't take things personally, right? That's a mindset thing. And then it changes my belief. Hey, it's not going to hurt me. This guy went with their cousin. And did I lose anything? Nah, a little bit of time, but I learned some experience.
Yeah.
And I showed more properties, and I became better at my trade. You know, that's a mindset thing, right? You're telling yourself a story. Somebody cuts you off in traffic. Well, they must have an appointment that they're going to, and they're late. Maybe they're an emergency. Maybe they just lost somebody. Maybe they're just in a bad mood. All right, that's just my mindset. Now I'm not angry, and I'm not flipping them off and honking my horn at them.
Yeah, that's a good point. What about like proximity? Do you have like a peer group that you try to be around regularly, or is it just your friends maybe that you've developed over time?
Friends and investors and clients. I love my clients. I love the people that I work with. I love the people that I get to serve. And I just like, I don't know, it's just fun. I'm around people that I like to be. You get to design your life as you want. I get to do what I want to do when I want to do it. There are different types of wealth. Without getting too cheesy, I always think of it as like there's the money wealth, there's the prestige wealth, there's time wealth, and there's health wealth, right? And you don't want to sacrifice time and health for the first two. And a lot of people, they're so zeroed in on those first two, money and prestige and being the best and having everybody kiss their, hiney and being kind of a turd at work and, all that stuff. And there's people that they never get away from that, and they suffer on the latter two. They work too much, and their health suffers.
Yeah,
and so you gotta just balance it out. And everybody's different. There's not a rule book. It's just what works for you.
How you mentioned a business mentor that you had. Like, did you guys have like a structured system you guys worked on? I mean, I'm a big believer in mentorship. I mean, it's amazing those nuggets of information. Or were you guys around each other a lot?
Yeah. So he was a friend of mine's dad.
Okay.
And so my dad worked for Boeing for 30 years, was angry, he was ticked, and not really, he was gone. He was in a different state. So when I went to college and stuff, I was on my own from, pretty much 17 on, right? A lot of folks know what I'm talking about. And it wasn't like, hey, I'm looking for a mentor. It's just Jerry was always interested. Hey, Toby, come here whenever you need. Hey, come do these shows with me. All right. I played soccer in college. So
that's cool.
I was doing stuff like that. And I was like, hey, if I had time, and I knew Jerry in high school because he's buddy's dad and stuff. And then here's a guy that actually says, hey, whenever you want, you can come here and work in the warehouse, come out and do trade shows. I'll show you the ropes. And then he was the one who kept saying the lawyers were idiots. They kept screwing up his deals. So his son went to law school. I went to law school. He went to law school. He got thrown out pretty quick, Jerry. Got thrown out within 6 months. He was very vocal and opinionated. But he was like, hey, you're going to be in business. You better learn this stuff. So he was one of those guys. Just encourage you to do stuff that you wouldn't otherwise. And, when you're a young man and you're...
It's important.
Yeah.
That's really important when you're... Even when I was in college, it's amazing how like some like long-term clients now, I mean, this is like, what were we in 2000? I graduated high school in 2004. It's 2024. So this is like freshman year of high school, like clients that I was 18, 19 that said things to me. And
still remember.
I remember them. Oh yeah, one gave me advice about getting married early. He was right, but a different topic. But anyways, career stuff about is like your trajectory of like how to structure things that were game changers. Like when the recession was going on, I wasn't, people weren't doing 5-year leases. They were doing 6-month leases. And it's funny, one client, one coffee, what he told me to do was don't try to do deals right now, try to build relationships.
Yeah.
And he gave me some ideas of how to get in front of banks. He's like, all banks and like asset managers who are going to be in charge of the foreclosing. He goes, eventually these are going to get sold off. And he was like, do something to add value now. And I was like, well, I don't have any money to do any of this. And he's like, doesn't matter, think of something. So I drove around and realized these buildings were dilapidated. So I just took pictures, printed them on computer paper, started mailing them to people, saying, hey, your window's broken, the weeds are overgrown, this doesn't like, And they started calling me from that. And I gave them handyman services. And then I ended up listing a bunch of them down the road. But that one coffee changed like me probably getting out of this business to thriving in a downturn.
It's so weird because I was just, as I'm sitting here listening to you and I'm thinking about this, people that I met at that time, kind of some of Jerry's friends, I was just thinking, I just had dinner with one of them. Another one I see probably on at least once a year. He comes into Vegas. Another one's here in Vegas. Cactus Joe. Actually, it's funny. It's like you start realizing all the people that you meet through it. I wondered if you ever took a little and started drawing out a diagram from the people that you met as a result of that one coffee, and you started like. There's a lot of times we don't tie it back. I did this because of this. I met this person, and because of this person, I met these three people. And you never tie it back to the fact that the original source was something as innocuous as having a lunch or a coffee with somebody that prompted you to look at things differently.
You know, I did that. I literally did this about a week ago. I have a team now, and I was always a solo person. And literally, I worked backwards with a client who said, hey, you're good at talking to people, like you're good at finding deals, but you need some help in the back end, like the organization follow up and like keeping your files in order. So I literally wrote a LinkedIn post that's kind of what I was looking for. And I found somebody, she had just parted ways with her team, and I was connected. Somebody who works for one of these big hedge fund companies was like, hey, you need to call this person. And they told me, like, put it into the universe. Like, I put a thing on LinkedIn. I hired that person. She's been with me for a couple of years, and I have another agent that works with, but it's just amazing. You're right. I did that. I'm like, this one event caused me to build a team, which made my income go up, and just more fun in the industry. So that is a fun thing to do, is kind of backtrack and look at how things evolved.
A lot of times you don't realize.
It's pretty nuts. We'll wrap up here in a second, but I wanted to ask you, what do you, are you into like, you've had some success in like real estate or that? Are you into like cars or watches or any of that stuff? Or are you just like, I was just curious. I don't know. Some people.
Yeah, no, I have watches. I never wear them.
You know, that's funny. I was having a conversation with a guy this morning. He just closed a big deal, and he wants to go buy a nice watch, and we're talking about that. And I think it's kind of cool that you hit a certain level, you've leveled up. Like, it's kind of neat. You get maybe a fancier car or something like that, but to be smart about it. And I find it so interesting as you watch people grow their career, their businesses, how they go through this phase where they're like hustling. Then they make a little bit of money and they want some flash. They want, a nicer truck, or they buy the Escalade. And then they like really level up and they go backwards. They want to be, like you said, they don't want anybody to know what they own. They dress really low key. They don't drive a fancy car. It's like the secret flex. And it's really interesting because in commercial real estate, again, I get to see a lot of financials. And I'm shocked sometimes you meet somebody. I'm like, wait a minute, you have how much money in your bank account? Or like, and they don't show it at all. So this whole idea of like what rich looks like or what success looks like is very perceiving, because a lot of people who have it, they don't want to show it.
I would say this, it's up to you. So there's different types of wealth.
Yeah.
Right? There's the prestige, big house, get your Rolls Royce, which I have nothing against. It's not me. I drive a Tesla. I just like not having to buy gas.
Yes, you like simplicity.
Yeah, it's like I don't even drive that much. We travel all over the place. You don't need a car when, you're sitting in your driveway. Great. But it's up to you. And I say everybody's different. You want the Ferrari? Great. Design your life to where that's something that you have. I just say don't work for it. Don't you be the one who's working for it. So if you have a really nice house and a really nice car, make sure you have assets paying for them so that you don't have to work. I just prefer to have that time freedom. I want to go to Fiji, I'll go to Fiji. If I want to go to London, I'll go to London. There's a certain amount of happiness that comes along just knowing you have that option. And then you may just stay at home, right? Yes. Hey, I may just be a homebody. That's cool. Everybody's different. And don't let anybody tell you what you have to be, or that you have to buy this or you have to do that. If you want to, it brings you happiness, go for it.
100%.
Yeah, that's it.
I'm the same boat as you with that. I drive I have an older Lexus. Well, I wouldn't say older, but a couple of years old. And I just got back from a trip. I went overseas and I went and rode a motorcycle through the Alps that I rented. And I got back and I was just like, that was epic. I did Lake Como and Lake Lugano. I was
just there. By the way.
Were you?
Like in May. Yeah.
I was there like literally last week.
We have an office in Lugano.
Oh, you do?
Yeah, that's where the Swiss office is.
That's funny. I know why you picked it. It's oh my God,
gorgeous.
what a stunning place. And the people were really nice. I actually went to dinner and met their pro volleyball team. So I was sitting there, and these group of ladies asked me to take their picture, and they're from all over the world, and they were all pro volleyball players. I was like, I didn't even know that was here. So yeah, friendly city too. So if you ever get the chance to check out Lugano, go there. But yeah, it's the same thing. It's kind of like if you only have a limited amount of time and resources. I don't care how much money you have, and do what brings you joy. That's for sure. But
so I'll give you one little fun thing. One of my favorite estate plans, and these are simple to draft, by the way. These aren't like tens of thousands of dollars. They're thousands, like maybe a couple grand, 2,000, 3,000. They put in their estate plan that the beneficiaries had to leave the United States 2 weeks out of the year.
that's incredible.
And go visit other countries. So you want to be a beneficiary? You want to you got to leave.
But that's awesome because travel, everybody has their one day. Someday I'll do this. And I'm like, someday might not come.
Yeah.
And I ride a lot of motorcycles. I love traveling on motorcycles. It's like the coolest thing in the world to me. Whenever I travel somewhere, I usually try to rent a bike for a couple days. You can get when I rode for a week, I was on a $35,000 brand new 2024 BMW. It was like $200 a day. I mean, it was easy. And actually, somebody ended up hitting my top box and broke it. It was insured. The motorcycle company was like, "Don't just throw it away. Don't worry about it. Enjoy the rest of your trip." I was like, "Okay," but just take advantage of your time out there. The world's incredible, and you meet some incredible people. And we get so caught up in this rat race. Yep. I mean, and that's why, as you said, this all ties back. Be smart with your money. It's hard to make it. It's hard to keep it. Structure it right, and get some cash flow going to enjoy it because it's short. Well, anyways, Toby, I know you need to run. You've got another appointment here. I really appreciate you coming in here. I could sit here and talk to you about this stuff for hours, but I would encourage anybody listening to this to check out Toby Mathis's YouTube channel. He has hundreds and hundreds, if not thousands, of videos, great content on tax liability and structuring your real estate. Toby, what's the best way for people to get a hold of you if they need your services?
Go through the YouTube. It's easy.
Okay.
And it's free. And then see if there's things that speak to you. And then if there's always an opportunity to chat if it does.
So Toby's big platform is YouTube, but he's also on Instagram and Twitter and all the good platforms. So Toby, thank you for being here with me, and I hope you have a great weekend.